So here we are. I think we can start the seminar. Good afternoon and welcome to you all to the third appointment of the new Women in Finance series at the Florence School of Banking and Finance. My name is Elena Carletti. I'm a professor of finance at Bocconi University, and I'm also the founder and director of the Florence School of Banking and Finance. I'm delighted to chair the lecture today. I would like to start by warmly welcoming our speaker, Irene Tinagli, and thanking her really very much for being with us today, despite her very busy agenda, as we were just discussing before the seminar. Irene is the chair of the Economic and Monetary Affairs Committee of the European Parliament, and in addition to that, she's also the vice secretary of the PD party in Italy. Before taking this position, she has quite had a rich career and also a little bit closer to the school in the sense that she started her career as an academic. So, and then moved to the public sector. In particular, Irene obtained a master and PhD from Carnegie Mellon University after her undergraduate studies in Bocconi. She was then an assistant professor of management at the University of Madrid from 2009 to 2013, when then she was sort of called by the public sector. So she started running for election, and she was then elected to the Italian parliament in 2013. She stayed there for 6 years, and then she ran again the election for being a member of the European Parliament, and she was nominated with over 106,000 votes. And this made Irene the most voted woman in the north of Italy for the Parliament. So congratulations, and very much in line with the series Women in Finance of successful women that make it to their career. The topic of today's event is the investment challenge in the European Union. How can the EU public policy help mobilizing public and private resources? And I could hardly think of a better speaker for that, given Irene's role and the Parliament. And I'm really looking forward to the talk and to debate afterwards and to see how Irene sees the future even beyond the next generation EU. Before giving the floor to Irene, let me just mention some housekeeping remarks. We will start with a talk by Irene that will last for about 35-40 minutes, and then we will open the floor for discussion. We have already received a number of questions, but please do not hesitate to post additional questions in the Q&A box that you see in the lower bar of Zoom. And at some point in the discussion, maybe we would start the discussion with this, given this is a series of Women in Finance, maybe we also want to touch the role on women and what the Parliament is doing also in the context of the new wave of funds that the Parliament and the European Union has now started. So now please, dear Irene, the floor is yours, and thank you so much again for being with us today. It's really a pleasure.
Well, thank you. Thank you very much for inviting me. It's really a pleasure, and I'm just sorry that we still are not in a position to do this in a physical format so we could meet, but you know, we'll do. We'll make it do. So the topic I've chosen is not accidental. Well, of course, as you mentioned, in my role of Econ Chair, I am involved with legislative and non-legislative initiatives on investments, finance, and so this is my daily activity. But I choose it also and mostly because I think it's something that it's somehow missing in today's public debate. I mean, we are talking a lot about, of course, the getting out of the pandemic, the post-COVID world, our ambitious climate and digital and the social goals that are set by the European Union. But I feel that we lack a broader discussion on how we can make these challenges possible. So, and this is not, that's why I think it's important to start with a brief assessment of the investment situation in Europe. The forecast by the European release, I think about 10 days ago, they paint a quite positive picture for investments. After a sharp fall of minus 6.3% in 2020, Total investments in the EU, I am excluding Ireland because the volatility of multinational behavior, but excluding Ireland, total investment in the EU is forecast to grow by 7.5% in 21, by 4.9% in 22 and 4.1 in 23. So this rise is supported both by private and public investments. Private investment can benefit from recovering profitability, raising demand, favorable financing conditions, and public investments can count, of course, on the support of Next Generation EU and also on favorable financing conditions as well. As a ratio to GDP, it's projected to be at 3.5% in 22 and 3% in 23. That being said, as much as the current scenario seems encouraging and gives, hope of recovery, I believe we shouldn't be too over-optimistic, believing that, this kind of scenario will stay like this forever. Because the road ahead of us, it's still hard. It can be bumpy. There are still several obstacles, sometimes even unexpected ones. We are seeing now the uncertainty with the new waves and variants. But apart from the unexpected ones, there are some that we can already foresee. For example, as we move forward, monetary support will diminish, will fade away. Financing conditions will probably not be as easy as they are today. Of course, also private businesses will have to face deteriorated balance sheets due to losses absorption and consequent higher leverage ratios. We haven't seen a lot of, bankruptcy in the past year and a half because of all the public support, but this will probably not last, when we might see deterioration in the near future. And also government's fiscal space will also shrink, as governments will be confronted with unprecedentedly high level of public debts, and fiscal rules will come back in the picture at some point, although we still don't know exactly in which form they'll come back, because you know that we are debating a change in the Growth and Stability Pact. But however, whatever form they'll take, the substantial increase in indebtedness will somewhat limit the margin of future maneuver for many governments. And let's also not forget, as I mentioned, it's not just monetary support in general, but the ECB's PEP program will end in the spring. And maybe also the collateral framework will go back. We still don't know exactly. We are waiting the December Governing Council decisions, but these are additional things that may or will pose additional pressure on indebted states. And also keep in mind that right now, more than half of member states have a debt higher than 60%, with an average public debt level, which is around 100%. So in the future, this will be a problem, but the real problem is not only the tightening conditions, the problematic condition, but the fact that this potential adverse scenario will come at a time where the European Union will be mostly in need of investments, because it's not the investment we are needing. They are not just there to get out of the crisis, but the investment needed are there to meet all the goals in terms of environmental transition, digital transition, social cohesion, fighting inequalities. So these are all goals that the European Union has rightlessly put at the center of the policy making, but these will require a lot of investments. So they are very ambitious goals. By 2030, for example, the EU should reduce its greenhouse gas emissions by 55% compared with respect to 1990 level, and should have at least 40% of renewable sources in its energy mix, and should increase its energy efficiency by 36%. In May 2020, in preparation of the proposal for the Recovery and Resilience Facility regulation, the Commission published a staff working document that tried to estimate, to identify the investment needs to reach those objectives. And the numbers are quite impressive. The European Union will need to invest approximately 600 billion euros per year to achieve that. 470 billions per year for the ecological transition and 125 billions per year for the digital one. So just to put this in perspective and looking only at the digital transition, for example, according to Bruegel's data set on the recovery plans, the first 23 plans put forward by member states together put on the table 127 billions for the digital transformation over a 6 years period. So, and we were saying 125 billions need per year. So think about the gap. So the importance of this challenge is, of course, manifold, touches upon many different types of issues. These objectives, of course, are important in themselves, but they also have geopolitical, social implications. I mean, the digital transformation, sometimes I think it's not fully understood in its meaning, but it's vital to make sure that Europe stays at the technological frontier and does not depend on foreign countries. Keep in mind, you know, that the 120 billions per year that I mentioned, they are not estimates to, how can I say, become the leaders. These are estimates based on the need to simply close the investment gap between us and the US or China. So this is the what we are talking about. Furthermore, medium to long-term growth depends on today's level of investment. So if private investments remain at a standstill, this will hamper future growth potential and use economy risk entering a vicious circle. So lower growth potential, make fiscal rules even tighter, leaving them less space to spend, forcing them to cast again on investments, hampering growth, and then causing foreclosures, higher level unemployment. So this is the risks that we could have. So this is why I think it's really important to act on that. I mentioned the digital, I emphasize the digital, but it's not just about that. Think also about social infrastructure, for example. No? We were already experimenting a gap, a lack of social infrastructure investments before the pandemic. The high-level task force on investing in social infrastructure put out this estimate between 100 and 150 billion per year as a gap in investments. And the Commission last May re-estimated these in 192 billions per year. So I think that if we don't take these challenges very seriously, what will happen is that our own democracies, the credibility of our democracies will start to cracking and to lose the trust of the citizens. So we need to act on this. Now, how can we act on these? Of course, there will be, as I said, the policy makers can act on to leverage the public investments and the private investment. On the public investment, you know, as I mentioned, we've done already a lot, but national public budgets, of course, cannot bridge this huge investment gap on their own. Even though now there is growing support for, you know, the idea that we need to change, for example, the Growth and Stability Pact in a way that treats more favorably or at least creates incentives for certain types of investments. But the issue of substantial indebtedness of the member states will remain out there and will pose in itself an evident economic constraint. So I think it's clear that public initiatives will have to be accompanied by even more substantial private funding. So here is the main issue. You know, and the question we should ask ourselves, are European financial markets ready for this challenge? And to be very honest with you, I think in this current moment, they're still not ready. We need to act. And what are the you know, the lines along which we need to work? The usual suspects, but with additional points that we will need to develop. First of all, of course, banking union, so the role of banking sector and the strategic role of the banking union, and then the capital markets union. So I will start with the banking union because, you know, it's crucial because European finance It depends a lot on the banking system, but still a lot on the national banking systems. And data show that this phenomenon is particularly strong in all the big member states, with some difference for the smaller ones. In 2019, the market share of the top 5 US banks was 43% of domestic consolidated assets, compared with only 23% for the top 5 in Europe. Fewer than 10 cross-border mergers and acquisitions deals have been signed since 2014, compared with 180 domestic deals over the same period. So you see where the problem is. And this situation is having a serious impact on our banks and might have negative consequences in the medium and long term. The market share of the 6 major US investment banks in Europe towards their 6 major European competitors has increased from 44% to 58% in the last 7 years. So larger groups are key in this historical phase of strong innovation. So I think this is something we need to put attention on. And the problem of this nationwide fragmentation of the banking sector, of course, is not new on the European political agenda. And the banking union is, I think, the only biggest response to this problem. And unfortunately, I have to say, banking union had a strong impulse at the very beginning and has achieved some important results, an efficient first pillar, supervision, an important but still improvable second pillar on resolution. But in more recent times, banking union, we have to admit, has lost a little bit of momentum and remains incomplete. So now, as a policymaker, we need to think, and I would like to engage you on this. Why is the banking union project at a standstill? Why it's so difficult to push it? I've been constantly asking myself this, and I don't have a recipe, but my impression is that, first of all, that the creation of the banking union was a consequence to the sovereign debt crisis in Europe. And in that moment, really, the importance was clear to everybody, the urgency. And right now, it's not perceived the same degree of urgency for some reasons. It seems like we have forgotten how important it still is. And second, I think we've spent too much time and energy on protracted discussions on the prerequisites and the preconditions, and it's like building constantly the preconditions to do something. And third, we insisted a lot on, we in the sense of the European, especially in the member states, with a lot of a sequential approach in which the issues are discussed piece by piece, one after another. So first we do these, and then if we accomplish this, then we could move to the next objective. But what happens is that the smallest obstacle on one of these pieces can bring the whole process to stop, which is what we have seen in recent years. So in December 2020, to give you an example, the Euro Summit tried to regive impulse and invited the Eurogroup to prepare on a consensual basis a stepwise and time-bound work plan on all outstanding elements needed to complete the banking union. It's been over almost a year, and there is nothing clear. There is not such a work plan. So I believe what we need, this is my view, I would like to hear yours later, we need to see things from a different angle. So the question we must ask ourselves is perhaps, why is the banking union still important for tomorrow's challenges? So we are still thinking of the banking union in terms of the previous crisis and the old challenges, but banking union is crucial for tomorrow's challenges. And moving towards a true single banking market through cross-border restructuring is above all a matter of strategic autonomy. Now it's, we talk a lot about that, about other industries, but it's important for banking industry as well. And genuine pan-European banking groups could really operate more effectively, raise their profitability thanks to scale effects, and better face up to foreign competition, especially from the United States, which we are seeing it's very aggressive. So at the macro level, banking union would decisively enhance private risk sharing within Europe. the political discussion remains primarily focused on public stabilization mechanism, like creating a common fiscal capacity. But we need to stress that private stabilizers are important as well. And banking union would enable, in conjunction with the progress towards a capital market union, a better channeling of our abundant savings towards the important targets of the EU in terms of digitalization and green transformation of our economy. So how do we go, how can we push forward banking union? It's not an easy answer to keep, but my view is that although we should still respect this holistic approach, as I mentioned before, not too fragmented, however, we could prioritize some work streams in light of their greater urgency in relative terms, and more essential role in completing the banking union. And of course, I'm referring to two main tools, which I know all of you are familiar with: the EDIS, the European Deposit Insurance Scheme, and the crisis management framework. I think these are the two reforms we need to do as soon as possible. They are pivotal to succeed in limiting market fragmentation and creating a real level playing field across the euro area. So I don't know if I have, it's already 1:22. Maybe I'm not describing how important and why EDIS is important. I'm sure most of you are familiar with. And also this bank's crisis management framework, which is maybe less debated in certain environments, but it's another topic very important, because all the actors recognize that the creation of a single resolution mechanism represented a big step towards facilitating the orderly resolution of significant institutions with minimal or not taxpayer involvement. But experience so far shows that there is still room to improve this framework. It does not seem to be fit for systemic-wide crisis, and this is something that the IMF said 2-3 years ago in their EU financial sector assessment program of 2018. And also there is another issue that we need to address, namely whether this BRRD framework is suitable for handling the crisis of small and medium-sized banks. And I think we need to address this issue, because the experience of recent years, also in Italy, I think already gives us an answer to this question. It's not suitable. Within the last 4 years, in all the crises of small and medium-sized banks, the European authorities themselves have constantly agreed with the national competent authorities that the solution to the crisis had to be found outside the BRRD framework, because the latter would have had required applying too rigid measures which were unsustainable to ensure financial stability. And that's the truth. I mean, most medium-sized banks, not to mention the smaller ones, are not equipped to tap capital markets to issue MREL-eligible instruments. So we need to, take note of these. I think around 70% of significant banks under the direct supervision of the ECB are not listed. 60% have never issued convertible instruments, and 25% not even issued subordinated debt. And and these percentages raise sharply among less significant institutions. So requiring these banks to issue MREL-eligible liabilities to non-retail investors would force them to resort to the wholesale market to obtain a credit rating, and it would be too expensive and unaffordable for them. So I think that we really need a harmonized framework for the crisis management of small and medium-sized banks that do not have access to MREL funding. And this would be ideally achieved via the implementation of a European framework for an orderly liquidation regime of banks failing the public interest test financed by the DGS. Everybody mentioned the positive example of the Federal Deposit Insurance Corporation, FDIC, in the United States. And it's true, they successfully managed the failure of, I think, about 500 institutions since the beginning of the great financial crisis. But most people forget that FDIC not only manages orderly liquidation or preventive measures. One of the key success factors of the FDIC is that the possibility of combining resolution and deposit guarantee functions for all US banks. And that's why I insist in saying that we need EDIS as well, and we can't proceed without this second pillar. So they need to go hand in hand. These two reforms have to be strictly interconnected, and we can't say first we do one and maybe then we do the next. Okay, I'm sorry, it took longer, but I think this was very important, at least for policymakers. It will be crucial in the coming months and years. And then, of course, as I said, there is the capital markets. You know, when we talk about making funding sources more efficient, you know, we cannot limit, of course, on banking issues. Also, financial markets have a relevant domestic bias and strongly affects the level playing field, so that companies in different member states face a marked difference in financing costs. There was a recent IMF study that shows that these costs depend predominantly on the country of incorporation of an SME. Data from a survey indicated interest rate on the debt, for example, for Greek firms, can be as much as 2.5 percentage points higher than the one faced by French firms in similar industries and sectors. And this is particularly relevant for startups in the field of IT, because you know, which are also constrained by collateral issues. So I think that equity-based financing is better fitted than debt to finance high-growth sectors such as this one. And it's interesting also to mention data from a Bruegel study that shows that difference in financing over the world. You know? And for listed domestic firms, the ratio of average debt to equity in the Union is $1.41 compared to 1.02 for the US and 1.09 for China. So especially in the most innovative sectors where normally venture capital plays a key role, Europe is really far behind and has 10 times fewer investments than the US. So we shouldn't be surprised when data show us that acquisitions of EU companies by US firms is almost 3 times bigger than the other way around. In the last years, we have been focusing largely on what kind of obstacles in the capital market regulation. But I think now we need to work on how to scale it up. And I think it should be clear that the Capital Markets Union can only work well when we have both micro and also some macro economic actions are advancing. I'll start from the micro considerations. For example, one key element is information on listed and unlisted companies. And on this regard, the European Single Access Point proposal, which was presented just a few days ago by the European Commission, that represents an important tool. This ASAP, this Single Access Point, will offer a single place with all the information for public, financial, and sustainability related information about European companies, investment products, and companies will have access to more source of financing by gaining visibility towards investors. A second point is the prudential regime for insurers and reinsurers. This is the core of the Solvency II review, and here the priorities will be given to policyholders' protection and financial stability, especially in the current framework of the low interest rate. And then the third major element is the lack of harmonization in the consumer protection legislation. I think this is also need to be emphasized. There can't be a true single market without harmonization. Cross-border standards, which will really enhance the trust of the consumers and investors in the system. I mean, we've been raising the bar with many files from the ESA's review to MiFID II, but we need to push also. Of course, on micro conditions, there are several other things. I'll just go quickly. Taxation, for example. it would play a key role for taking up some activities, and especially their cross-border application, because the current fragmentation of these taxation regimes in different member states limit the economy of scales of these funds, which are unable to compete with international ones. Then, of course, harmonization of insolvency practices, and then, of course, supervision. That also, I believe, should be enhanced. There is still too much fragmentation, and this, of course, is a big problem. On the more macro consideration, I will just mention one. I believe, and this is also something that now it has lost momentum, nobody seems to talk about it, but really, a genuine CMU requires the possibility for investors to build a balanced portfolio with European assets. And this is indeed a key element. And today, this role of safe European asset is mostly performed by the German Bund. And this is not sustainable. And I think that the creation of a common safe asset issued in appropriate size is fundamental. This would become a benchmark for investors, foster the financial integration. And we've seen it, with the issuance of bonds for SURE, for the RRF. We've seen how these instruments are extremely attractive for investors. And this would grant also a high level of shock absorption capacity, and it would contribute to ensure an effective transmission of monetary policy decisions. So I'm getting towards the end. I just want to say one last thing on sustainable finance, because I've talked at length about banks, financial markets, but I think that to finance all the challenges that we face, we need also to find ways to direct resources where are most needed with appropriate tools and regulations, and thinking about the Green Deal. That's where a lot of our effort as policymakers has been put and will be put also in the coming months. Because here the main issues are the mispricing of bonds and securities and the asymmetry of information between actors that lead, of course, to insufficient investments towards the transition. But you've seen how much we will need of these investments. So I think the European Union is working hard on this regard, in increasing the availability of information and harmonization of definitions for a true assessment of sustainability projects that will give that credibility and create a real market. So, and we are also working to give the right incentives to financial intermediaries. Here we have two things: disclosure and taxonomy regulations. These are the two pillars of the European initiative on this sector. And the particular taxonomy is the most ambitious green asset classification project at international level. And the new Commission proposal on the green bond standards will also represent another step in this direction. Then, of course, further action for correct incentives to the financial intermediaries are also included in the recent banking package put forward at the end of October by the Commission. We still have to start working on it, but we will do it. And the sustainable finance strategy would be incomplete if this is concentrated exclusively on a disclosure requirement for financial intermediaries, because we know that the problem lays also in the corporate reporting. So we need to overcome the information gap that currently exists between companies and intermediaries. And so we need a reform to overcome some of these limitations in the current corporate disclosure, because now it's mainly based on backward-looking indicators, often generic, no quantitative objectives. So this step is very important, and we will work on it very carefully, also taking into account a proportionality, because of course small and medium firms, we can't risk to keep them outside this big project. So I'm closing. I said 35 minutes 40, so I have just a few minutes just to convey to you what I wanted to address in this lecture is to a topic that unfortunately is often ignored in political and public debate. And sometimes, yes, we talk about specific measures of banking union, Capital Markets Union, it is safe asset, but I think that we lack the main vision of why they are important today, why they are crucial, and why they are crucial together. The vision of how we should support, how we could support the investments. When the Commission presented the new Green Deal, or the Fit for 55 package, there was some criticism, saying that this is too ambitious, we cannot make this transition. But I think that the point is that these challenges, environmental, digital, social challenges, are not something we can decide not to act upon, and we cannot ignore them, because we will see greater environmental problems. We might see, unfortunately, further social tension. We might see loss of competitiveness of our products. These things will force us to act. I remember when I talked to Ursula von der Leyen at the very beginning of her mandate, before she announced the Green New Deal, she told me, we are not inventing priorities out of nothing. These priorities are given us by nature itself and by science. It's not even politics, it's science telling us. So we cannot beg. And so the question, we shouldn't be saying that, no, we can't afford it. I think that the real question we should be asking is, how can we afford it? What can and should we do as soon as possible to afford it? I think that, financing this transition is perhaps the most important challenge of our age. And so what I've tried to tell you in this lecture is just what we've done so far, what are we doing, and above all, what I believe we should be doing in the coming months and years. Thank you. Thank you very much.
Thank you, Irene. Thank you very much for this inspiring talk. I must say, I share basically everything you said, but one aspect I share in particular more than others, which is your final remarks on we need a vision and we should build things, and the European infrastructure having a vision in mind, where Europe wants to be in the next years, decades. And that's something typical that seems to me that is missing in the European history, if we want. And also you mentioned banking union, and you rightly said that banking union is the result of the previous sovereign crisis. If I think of most of financial regulation, that is the same. So it's not built with an idea in mind, but is always built as a response to something that happened in the past. But we should have more the future in mind, because maybe if we had that, we wouldn't be always so running behind in terms of competitiveness, in terms of everything, basically. So I think this is a very, in a way, if you allow me, it's a simple but very deep message. And it's something that, as you say, it's normally missing in our considerations when we think of policies and what exactly we should do, both at the national and the European level. And this is true for all fields. It's not true just for banking. It's really an overarching topic and priority that we should all have in mind very firmly. So I'm fully on your side in pushing for this. Let me come to the question. If we want, we have 20 minutes. So let me start spending a few minutes, which maybe is not as relevant in the context of what you said, and I think we should really discuss what you said. But one aspect that you haven't mentioned is the role of women. And recently, in particular, in terms of, for example, we started talking about growth, and you started by talking about the growth rate that we may see coming forward. How do you think is the role of gender or more gender balance? Because that's another aspect where Europe, and especially some countries more than others, lags behind relative to the US, for example.
I think it's, thank you so much, because this has been part of the effort I've put in my mandate as chair of the Econ Committee in the past 2.5 years, because I truly believe that the role of women is crucial in terms of bringing up diversity, bringing up different perspectives. When you have a small pool of people taking decisions, and these people all have the same experience, think the same, we end up having suboptimal decisions. So I think it's very, very important. This is not me saying that, but there are decades of, research in behavioral economics and decision making. So I'm not going into that. said, but I do believe that including women in financial and banking industry, which is still predominantly male, especially at the top. And what I've seen when I started my mandate is that all the economic governance in the European Union, all the authorities, the agencies were predominantly male at the top. And, we as Parliament, as the Econ Committee, we play a role because every time we have a new appointment for a chair or executive director of the ESAs, we have to vote them. So they have to go through Parliament. But the selection process happens in the authority. So the selection process happens outside the Parliament. They come up with a list of, let's say, finalists, and then they pick one name. And what I realized that for too long, even in this process, women were not included. And when we got to the final list of, the final 3 or 5, they were all men. And so we fought a real battle. I understand that when you have to decide one position, it can't be gender balanced, because if you have to choose one chair, either is a man or a woman, it can't be balanced in itself. It's not that point. The point is to have a gender balanced process, is to make sure that women have a chance to be included in the process and to be evaluated and brought to the final list of, candidates. So we've insisted a lot on this, in some cases also very hard, say, we will refuse to evaluate candidates if they are not gender balanced. And I have to say, we've seen a lot of improvement. In the past 2 years, all the final candidates submitted for evaluation, they were gender balanced. And actually, I think that I tried to count, I think right 50%. I think we had 14 nominations in the past 2 years and a half, and at least 7 of them are women. And they are also at the top position. So chair of EIOPA, chair of ESMA, executive director of ESMA, of course, president of the ECB. So the 2 members out of 3 of the new CCP supervisory committee. So there are now many more women, but of course it's a battle that we need to keep fighting, because in Brussels we are putting a lot of effort. But what we see is that in the member states, at the national level, national authorities, they are not making the same effort. And of course, this makes things difficult, because more often than not, are the national authorities the places where the first choices are made to, which person indicates for that kind of European position. So we need to work more at the national level. I think that in Brussels, we can't do much more than what we've done. Right now we have, and also, Commissioner McGuinness, Lagarde, so me. So we do have many women, but we need a bigger effort on the side of national authorities. Central banks also as well. It's crazy. I mean, it's so painful when you see all these, central bankers.
Yeah, when you see the governing council, is a bit discouraging. Let's put it this way. On this, let me say that on this Friday, actually, we were going to have a debate in FPF discussed together with Women in Finance, and we will have Sylvie Goulard, who is a representative of a national central bank, female member, together with Irene Adams. We will be discussing quotas, but we will be discussing the role of quotas more broadly, so not just in boards, but also in central bank executive bodies. Let me come back now to the issue that you discussed, because we have a number of questions that I would like to pose to you before we close. So let's start with the one by Bernard Cazet, that is on what does it mean investment? Because you have been talking a lot about we need more investment, and giving quite striking data of how much investment would we need on the one end and how much investment at the moment we have. And the gap seems to be huge. Basically, in 6 years is what, for example, if I remember correctly, the number you said on digital, we should have the investment of 6 years in 1 year, and instead we are really very far from the target. So the question by Bernard is, what do you regard as investment? Is it spending? Is spending on health an investment, or is it consumption? Is it spending on education or investment, or is it consumption in brackets always? I've heard that some people calling spending on defense and investment. Would you have a golden rule? Only investment can be permitted to result in a deficit. But if so, what counts?
Oh my God, this is a big question. I mean, I think this is what most people have been debating and fighting also, especially when we talk about fiscal rules and what should be counted as investment and what spending. Of course, traditional investment is something that is lasting, is long-term, and enables growth. For example, in terms of, I don't know, you mentioned defense. Of course, defense include many different kind of expenditures. So you can make an investment in research, for example. Many innovations, technological innovation has, or technological instruments are developed and produced in defense, or you could be talking about expenditure in consumer, intermediate consumer goods, or salaries for people working in the sector. So typically salaries are considered as current expenditure, not an investment. Of course, there are some circumstances where it's not that easy to to find a clear, cut between. We've experienced that in the pandemic. So education is often considered expenditure, but some infrastructure, like the digital infrastructure of the education, that's clearly an investment. And we experienced during the pandemic how crucial it is. Healthcare. Of course, a big chunk of healthcare is always been considered as expenditure because a lot is about personnel and wages, etc. But when you talk about ventilators, when you talk about, is that current expenditure or has become a sort of an investment now? Because if you have ventilators, if you have intensive care slots, you can be more resilient next time a pandemic hit us. So right now, I think it's about time to also rethink about what do we mean? What is really a strategic investment? What makes not only increases the growth potential, but increases our resilience? Because now we talk about recovery and resilience. So maybe what we were not used to think about as an investment, maybe in light of what happened in the past year and a half, maybe it is a good investment to have a good healthcare system, because when the pandemic hits, if you have to do a lockdown that lasts 2 years, that hinders growth potential. We've seen it. So this is the big debate we are actually going through now. Of course, one thing is debating in theory about how you define this. Another thing is how you incorporate and count this in fiscal rules, because that's a different thing. And this is the main problem in reviewing fiscal rules in a way that allows for real, growth enhancing investments and make a distinction between the two. So for example, right now, in light of what happened in the past 2 years, in light of the challenges that I mentioned, some economists, some experts talk about green investments. But that also is, what is a green investment? What is an investment that can be counted not as an expenditure, but as a long-term investment in the terms of transition? How do you measure it? How do you ensure that this is growth enhancing and long-term? So although on that front, all the tools that we have developed, I think could help in assessing, in delimiting, in defining what's sustainable, what's not sustainable, what kind of output, what kind of results. So I think it's an effort we have to put on several fronts. So the theoretical debate, but also the practical development of instruments, indicators, to avoid and prevent what many economists call moral hazard. So you want to create real flexibility for real investment. You don't want to create incentives for moral hazard behavior. But I think this is something that, especially in light of what we have experienced in the past 2 years, it's really urgent to do. I mean, we cannot keep thinking of investments only in terms of railway and bridges and tunnels. I mean, it's ridiculous.
Talking about visions for the future, that's ridiculous. Exactly. So following up on this, do you think that taxonomy alignment investment could be exempted from the debt GDP ratios?
I cannot answer this. No, I can't. Okay, I mean, okay. I would be killed.
Let's leave it. Let's.
No, okay.
I understand that this is a bit complicated to answer.
No, taxonomy, it's been one of the biggest, but also most complicated, both from a technical standpoint, but especially from a political standpoint. And it still is. You know that we are still waiting for other delegated acts. So it's still a process, an ongoing process. I believe this is, we need to use this instrument in a smart way, which could go beyond financial instruments. I think we should use it to also, in a broader context, to support and finance this transition. But I can't say too much because this is an ongoing. No, but there is a debate. As I said, it's a huge debate. So I understand the interest in this debate.
Yeah. So you have been talking in various occasions, actually, on the European Union Green Bond standards. So the question is, by an anonymous attendee, looking at the forthcoming EU Green Bond standards, what is your view on this tool in the landscape of the EU public policy aiming at mobilizing public and private resources?
I think we are still starting. So green bonds is a dossier we just started in Econ. So we still have to see how it will shape, what kind of form. But I do believe that this will be a crucial instrument to give certainty to the investors, to attract investors. As I said before, sometimes when we keep vague, on what is what, it seems to us that it's better to have this vagueness, but it's worse because you create ambiguity, you create mistrust in the instrument, so you create room for misuse of the instrument. So I really believe that green bonds can be the right tool, one of the tools, of course. We are creating one of the tools that could really help us mobilizing resources to support the ecological transition, which will be huge. I mean, what I said, 470 billion euros per year, and especially for big industrial economies like ours. Sometimes I'm afraid that we don't fully grasp all the implications. For example, I think like in my region where I live, Lombardy and Piedmont as well, the automotive industry. Can you imagine the amount of investments to really transform, to really, transition this industry towards zero net emissions and sustainability within few years, very short time span. So we will need billions and billions. And I think we need instruments like green bonds that could clearly and us are able to convey investments into sustainable projects.
Yeah. Still talking about the public and private, and then I would like to spend a few minutes on the banking union that you mentioned. There is another question by Pier Federico Asdrubali asking, would you be in favor of a future expansion of programs like Invest EU, which can mobilize hundreds of billions of private investment through extremely limited EU budget resources?
Okay, so this is you have to give me a few minutes on this. I know that
absolutely, take the time.
I think InvestEU. We've seen the experience with FC, which was the Juncker plan, which is basically the predecessor of InvestEU. I think this should be the kinds of project that the European Union should finance and support with much stronger resources and enthusiasm and commitment. I mean, because we cannot always decentralize. Okay, let's face it. I mean, Next Generation EU is a fantastic instrument, but it's mostly decentralized. It doesn't have a real European project that finances European infrastructures with the European vision, you know. InvestEU is one of such programs, and it works well, at least so far. FC has worked very well. In Italy, Italy has been one of the biggest beneficiaries. It promotes, you know, partnerships. It promotes private-public support, partnership, collaboration. It supports innovative projects with a European vision. And when we negotiated InvestEU, since we were in the middle of the pandemic, we tried to negotiate not only some windows dedicated, for example, to the social infrastructures, to SMEs. So now there are all these dedicated windows to things that we believe are priorities for the European Union, not just for one member state, but we also included the possibilities, which was pretty groundbreaking, to use these European public guarantees, not only to support investments and loans, but also to support solvency, recapitalization. And why we did it? We did it because the European Commission, at the beginning of the pandemic, when it proposed the first idea of the next generation package, it had included this solvency support instrument. I don't know if some of you had heard of it, because the European Union realized that in light of the pandemic and in the post-COVID Europe, we would have too much indebted private sectors and companies if we didn't give them not only moratoria or granted loans, but also if we didn't give them the ability to have the possibility to have recapitalization. So in some member states, it was the member states did it, but in other member states, there was not the fiscal space to do recapitalization. So we needed a European instrument to do that and avoid that the pandemic would increase divergences across the European economies and member states. So, of course, we tried to include this possibility in the InvestEU, but InvestEU is a small instrument. I completely agree. We need to put more resources, and we had to fight together with the budget committee to put some more resources in InvestEU, because they didn't put enough resources, and there are still few resources, but this is a good instrument because, as Pier Federico said, the leverage is extremely high. So that's where we should put our effort. There is an investment committee, there is a good, serious selection of projects, there are partners, there are national banks, promotional banks that also can intervene. They know the market very well, they know the actors. I think we can create a very positive cooperation between European institutions, national institutions, and achieving European objectives. So I really thank you for this question, because I do believe that instruments like InvestEU are the way we should go in a much stronger and robust way.
Yeah, just as a follow-up by Alice Zoppe, is the European Investment Bank the right EU body to manage InvestEU? Can you answer to that?
Okay, I need to, I mean, the European Investment Bank has proved to be to work well, but of course, when we negotiated the instrument, for example, we negotiated for a role also, a bigger role of the national promotion banks, because I think it's also important to have partners, implementing partners in the member states, because they know the context, they know the industries, they know the entrepreneurs, they know. So I think that if we strengthen this network of implementing partners and actors, also if we encourage, one thing that maybe we should encourage more is a better cooperation and exchange of information between the European Investment Bank, the National Promotion Bank, and the smaller local banks, for example, to reach out to smaller firms in the regional context, which often they don't even know about these opportunities. So if we want to improve the transmission of these resources supporting growth, we need to probably do a little bit better in creating this network and this cooperation at the European, national, and also local, regional level.
Yeah, I absolutely agree with you. Let me just ask a final question, because I understand this too, and you will have plenty on your desk to do after this.
I have to go to the airport.
But just 1 minute, if I can still steal it. You talk about completing the banking union, and you mentioned EDIS on the one hand and crisis management on another. Now, these are all, of course, we move backward, as we say, in game theory or in other microeconomics theories, and therefore these are important. But both of these elements are there for when banks are sort of gone concern. So when banks are in trouble, so these are financial stability tools more than anything else. My question is, it seems to me that one of the main impediments for cross-border groups in Europe is also the supervision. I mean, the fact that despite having the first pillar, which is up and running and very efficient, as you said, there are still national differences or ring fencing that really affect and decrease the working of, and the possibility of exploiting synergies of scale in particular, of the large groups. I mean, let me mention the famous trap liquidity in Germany, or the difficulty of moving capital across subsidiaries. So you didn't mention this aspect, but in my view, these are at least as important, if not even more important, to convince cross-border mergers going forward. What would be your view on that?
I agree. I agree. We need to push. Some tools would be stronger and better implementation of, liquidity waivers, instruments like these that could help addressing almost issues, avoid ring fencing. We need to intervene. I completely agree. Now, I mentioned the two biggest, topics, and the ones on which we will be also
and the one on which probably you have more of an impact in a way, or more possibility of having an impact.
Yes, the national, I completely agree, and I would be available if you want to have also a meeting,
absolutely.
If there is something that you envision that we could do to improve that, because I completely agree. And when I talk with the few big groups or big banks that we have in Europe, they are all saying we are giving up because we are not pushing on this, because we are tired of fighting with all these different and with this ring fencing attitude that many countries put in place. And so we don't have now enough time, but I would be really happy if you are interested in this, and if you have ideas on how we could
do something on that. Actually, let me mention that FBF has a cross-border academy. Actually, on the 10th of December, we are going to have a big panel on it. So we will come back to you, certainly, if you have an interest in this topic, because I think this is very important. At least as important as EDIS and the rest of the things you mentioned.
Yes, absolutely. Yeah. And it's good to have, an idea of how complex and how many things, because it's true. Sometimes we focus only on the biggest but also most controversial issue, which is, and then we miss pieces that maybe with some efforts could be done more easily, but they're important. So I think it's good to have this holistic approach and look at everything.
Okay, let me stop. Let me thank you very much again, Irene, for having been with us. I think this was a wonderful discussion. Thanks a lot. You've seen that there were many questions that were very close to your heart. So thanks again, and good luck, and continue the good work you're doing at the Parliament. Thanks again.
Thank you.
And to the next occasion. And thank you to all the attendees. Bye-bye.